Gold just hit record highs. Central banks bought nearly 900 tons of it last year alone. So why are Russia and Turkey suddenly selling? Here's what nobody is telling you. When the institutions that print money start dumping the one asset that can't be printed, that's not a market signal. That's a warning alarm. And if you don't understand what's happening right now, you're going to be the last one to find out. Now, before we get into what this all means for you, we need to talk about who is actually selling gold right now, because this is where it gets interesting. When you hear that central banks are selling gold, your first instinct might be, okay, so what? People buy and sell things all the time. And you'd be right if we were talking about stocks or bonds or any other financial instrument that gets traded in and out based on strategy. But gold is different. Gold isn't something a central bank casually offloads on a Tuesday afternoon because they found a better trade. Central banks hold gold because it is the last line of defense. It is the one asset on the planet that carries no counterparty risk, that cannot be printed, cannot be sanctioned, and cannot be frozen by a foreign government overnight. So when a central bank starts selling gold, not buying, not holding, selling, you don't shrug that off. You ask why. And the answer in this case should make you deeply uncomfortable. Russia and Turkey are the largest net sellers of gold in 2026. Russia's sales point to mounting fiscal strain as wartime spending and sanctions continue to pressure government finances. Turkey's reductions are driven by domestic pressures, including efforts to stabilize the lira and manage surging local gold demand. Let that sink in for a second. These are not small, obscure nations quietly rebalancing a portfolio. Russia and Turkey are major global economies, countries that spent years aggressively building up their gold reserves precisely so they would never be in a position of weakness. And now they are selling, not because gold is a bad asset, not because they found something better, but because they are running out of options. Visual capitalist, think about what that actually means. The Central Bank of Russia began selling gold in 2025 to help fund the Kremlin's war in Ukraine. This is a country using its most precious financial reserve, the asset it accumulated for decades as a shield against exactly this kind of crisis, to pay for a war it cannot afford to lose. That is not a financial strategy. That is financial desperation dressed up in official language, and Turkey is not far behind. The Turkish lira hit another fresh record low, its 11th since the conflict in the region began just 16 trading days prior, and reports emerged that Turkey may sell or borrow against its gold reserves to try to defend the lira. Borrowing against your gold just to keep your currency from collapsing. That's the equivalent of pawning your last valuable possession to keep the lights on. Bullion vault now. Here is what makes this story truly alarming, and why it connects directly to everything else we are going to talk about today. The freezing of roughly $300 billion in Russian central bank assets in 2022 marked a turning point for global reserve management. Since then, countries like China and several Central Asian economies have accelerated diversification into gold. Unlike foreign currency reserves, gold is not subject to foreign jurisdiction, making it attractive in a fragmented geopolitical landscape. In other words, the entire world watched what happened to Russia in 2022, watched a major nuclear power have its foreign reserves frozen with the click of a button, and they said, we need gold and we need it now. Countries scrambled to protect themselves with the one asset no government can confiscate remotely. And Russia, the very country that triggered that global realization, is now being forced to sell the protection it built. Visual capitalist, that is not irony. That is a tragedy unfolding in real time on the global financial stage. And if you think this is just a geopolitical story happening far away from your life, from your savings, from your financial future, think again. Because what happens when desperate nations start dumping gold onto the market is only one side of the equation. The other side, who is buying every single ton they sell, that is where this story gets even more alarming. You said, expand key point 2 into a 700-word segment, flowing naturally within the speech and maintaining alignment with the overall key points. Expand key point 2 into a 700-word segment, flowing naturally within the speech and maintaining alignment with the overall key points. Avoid any headings and ensure the tone is seamless and conversational. Conclude with only the necessary closing line for impact, and don't mention Felix Academy name, and write it like Felix Academy is giving speech 4:38 a.m. you're wrong, Claude responded. Here is the expanded key point 2 segment, 700 words. Here is the expanded key point 2 segment, 700 words. So we just established who is selling. Desperate governments, countries under sanctions. Economies trying to hold their currencies together with whatever they have left. But here is the question that should be keeping you up at night. If Russia and Turkey are the sellers, who exactly is on the other side of that trade? Who is buying every single ton that hits the market? The answer is everyone else, and not just buying, aggressively accumulating. At a pace and scale that the modern financial world has almost never seen before, let's start with the raw numbers, because the numbers here are not subtle. Central banks globally purchased 863 tons of gold in 2025. While that figure falls slightly below the record-breaking pace of 2022 through 2024, it remains dramatically higher than the pre-2022 annual average of just 400 to 500 tons. In other words, even in a so-called slower year, central banks are buying gold at nearly double their historical rate. Double, not 10% more, not 20% more. Double the historical average in what analysts are calling a slow year. Let that reframe how you think about what is happening right now. ISA bullion, and this isn't one or two countries skewing the data. 22 institutions reported an increase in their gold reserves of around a ton or more during 2025, with 7 responsible for the bulk of the buying. This is a globally distributed trend. This is institution after institution, country after country, all arriving at the same conclusion independently, that gold needs to be in their vault. And it needs to be there now. When 22 separate central banks are all moving in the same direction at the same time, that is not a coincidence. That is a signal. World Gold Council, but perhaps the single most important data point in this entire conversation, the one that very few people are talking about, is this. Gold now accounts for a larger share of central bank reserves than US Treasuries for the first time since 1996, according to Morgan Stanley research. That is a historic turning point since 1996. Think about everything that has happened in the world since 1996. The dot-com crash, September 11, the 2008 financial crisis, a global pandemic, and through all of it, through every shock, every crisis, every moment of uncertainty, US Treasuries remain the dominant reserve asset for central banks around the world. Until now. Right now, in 2026, gold has overtaken them. That is not a small headline buried on page 12 of a financial report. That is a fundamental restructuring of how the world stores its wealth. ISA bullion now, ask yourself a serious question. These are not amateur investors. These are not retail traders chasing momentum on their phones at midnight. Central banks increasingly cite the value of holding a non-sovereign asset that cannot be frozen or subject to counterparty default. These institutions manage the financial survival of entire nations. They have research departments, economists, geopolitical analysts, and decades of institutional memory. And they are all collectively, simultaneously rotating out of US dollar assets and into gold. If the people responsible for protecting national wealth are making this move, what does that tell you about the direction they believe the world is heading? BitJet, the World Gold Council's 2025 Central Bank Survey, 95% of central banks expected global gold holdings to increase over the following 12 months. Not one expected a decline. Not one. Out of every central bank surveyed on the planet, not a single institution looked at the current environment and said, you know what? I think we should hold less gold. Every single one either expected to hold the same or increase. That kind of unanimity in finance is almost unheard of. ISA bullion, so we have desperate sellers on one side and an overwhelming wave of sophisticated, well-resourced, long-term institutional buyers on the other. And while all of this is happening, while the world's most powerful financial institutions are quietly loading up on gold at record levels, the average person still has no idea why the dollar itself may no longer be as safe as they think. That is exactly what we need to talk about next. So now we know who is selling and we know who is buying. But if we stop there, we are only looking at the surface of something far deeper and far more consequential. Because the real story, the story underneath all of these numbers and central bank decisions, is not actually about gold at all. It is about the US dollar and what is happening to its role as the foundation of the global financial system. For the better part of the last 80 years, the world has operated on a simple, almost unspoken agreement. Countries earn dollars, save dollars, and store their wealth in dollar-denominated assets, primarily US Treasuries, because the dollar is safe. Because the US government has never defaulted, because American financial infrastructure is the deepest, most liquid, most reliable system on earth. That was the deal. And for decades, it worked. The dollar was not just America's currency, it was the world's currency, the universal language of global trade and global reserves. But something broke that agreement. And it happened in a single moment in 2022 that most people watched on the news without fully understanding its implications. The freezing of roughly $300 billion in Russian central bank assets in 2022 marked a turning point for global reserve management. In response, countries like China and several Central Asian economies accelerated gold purchases, treating bullion as a reserve asset that sits outside the reach of foreign governments. Read that again slowly. $300 billion. Frozen. Overnight. Not stolen, not lost in a market crash. Frozen by a political decision made in Washington. And every single country watching that moment had the exact same thought. If it can happen to Russia, it can happen to us. Visual capitalist, that is the crack in the foundation. That is the moment the unspoken agreement started to break down. Because the entire value of holding dollar reserves, the entire point of storing your national wealth in US Treasuries rests on one assumption, that the United States will never use that system as a weapon against you. And in 2022, that assumption was shattered publicly, permanently and irreversibly. You cannot unsee what was done to Russia's reserves. You cannot unknow that your dollars sitting in accounts tied to the US financial system are ultimately under American jurisdiction. And if your foreign policy ever puts you on the wrong side of Washington, those dollars are not yours anymore. Central banks increasingly cite the value of holding a non-sovereign asset that cannot be frozen or subject to counterparty default. That phrase, non-sovereign asset, is the key to understanding everything. Gold has no government behind it. It has no jurisdiction. It cannot be sanctioned. It cannot be frozen with a phone call. When you hold physical gold in your vault, it belongs to you completely and unconditionally, regardless of your political relationships with any other country on earth. In a world that is fracturing along geopolitical lines, that property is not just valuable, it is irreplaceable. Get. And this is not a fringe view held by a handful of paranoid governments. Even smaller buyers such as Cambodia and Serbia are gradually increasing their gold allocations. Cambodia, Serbia. Countries that a decade ago had no meaningful gold accumulation strategy whatsoever are now quietly building reserves. Because the message from 2022 traveled everywhere, to every finance ministry, to every central bank governor, to every national treasury on the planet. The dollar is not neutral, and anything that is not neutral carries risk. Visual capitalist, now here is where this connects directly to you. Sitting here today, thinking about your savings, your investments, your financial future. The same logic that is driving central banks to move out of dollar assets and into gold applies to every single person who holds their wealth in a currency they do not control. The value of central bank gold holdings as a share of global GDP has risen during the past quarter century, reaching 2.5% at the end of 2024. The world is quietly, systematically, deliberately shifting its financial weight away from paper promises and towards something real. Brookings, the dollar's crown, is slipping, and the people who understand that earliest will be the ones best positioned for what comes next. Which brings us to the most urgent question of all. How high can gold actually go, and what does that mean for you right now? So here we are. We have walked through who is selling and why it signals desperation. We have looked at who is buying and the sheer unprecedented scale of that accumulation. We have pulled back the curtain on what this really means for the dollar and the global financial order that has governed the world for 8 decades. Now comes the part that matters most to you personally, because everything we have discussed so far is context. This right here is the consequence. Let's talk about where gold is going. And more importantly, let's talk about what happens to the people who are not paying attention. The price forecasts alone should stop you in your tracks. JP. Morgan Global Research forecasts gold prices per ounce to average $6,000 by the final quarter of 2026, rising towards $6,100 by the end of 2027. This is not a fringe prediction from a gold enthusiast on the internet. This is JP. Morgan, one of the most powerful and conservative financial institutions on the planet, putting a number on paper and standing behind it. And they are not alone. ING forecasts gold averaging $4,325 per ounce in 2026, while JP Morgan Global Research sees prices potentially reaching $5,000 per ounce by Q4 2026. State Street Global Advisors puts a 30% probability on the $5,000 mark being reached this year. Multiple major institutions, multiple independent forecasts, all pointing in the same direction. When the largest financial minds in the world converge on a single asset with this kind of conviction, the question is no longer whether gold goes higher. The question is whether you are positioned before it does. JP, Morganese bullion. But here is what makes this moment uniquely dangerous for the average person. It is not that the information is hidden. It is not that this is some secret only accessible to the wealthy or the well-connected. The data is public. The forecasts are published. The central bank surveys are available to anyone with an internet connection, and yet the overwhelming majority of everyday investors are sitting completely on the sidelines, watching this unfold without taking a single step. In the World Gold Council's 2025 Central Bank Survey, 95% of central banks expected global gold holdings to increase over the following 12 months. Not one expected a decline. Not one institution, out of every central bank on earth, looked at this environment and said gold is going down. But the average person still waiting, still hesitating, still telling themselves they will look into it later. I say bullion later is exactly how people miss the most significant wealth transfers in history. And make no mistake, that is what this is. Gold prices surged more than 230% since 2020, fueling one of the strongest official sector buying waves in decades. 230% in 5 years. And the institutions driving that move are not slowing down, they are accelerating. The World Gold Council forecasts central banks to purchase roughly 850 tons of gold in 2026, almost the same as last year. The buying is structural, it is strategic, it is long-term, and it is not going to pause politely while you make up your mind. Visualcapitalistmining.com there is also something else happening beneath the surface that most people completely overlook. Chinese net imports of gold inflected sharply higher, coming in at 317 tons in the first quarter of 2026 alone, up by nearly 3 times compared to the previous quarter. 3 times in a single quarter. China is not just buying gold on paper, they are physically moving it, importing it, locking it away, and they are doing it at a pace that suggests they know something about the timeline that the rest of us are still trying to figure out. JP. Morgan, this is the moment in history where the gap between those who understand what is happening and those who do not will translate directly into a gap in financial outcomes. The institutions know it, the governments know it, the data confirms it. The only question left is a simple one, and it is entirely yours to answer. Are you going to be the person who watched this happen, or the person who was ready when it did? Let's take a step back for a moment, because we have covered a lot of ground today, and I want to make sure that before you walk out of here, every single piece of this puzzle is sitting clearly in your mind, not as separate ideas, but as one complete, coherent picture. We started with a question. Who is selling gold, and why should that scare you? And what we found when we pulled back the curtain was not just a financial story. It was a story about desperation, about power, about the quiet unraveling of a world order that most people have never thought to question. Russia selling its most precious reserve asset to fund a war it cannot afford. Turkey pawning its bullion to stop its currency from collapsing. These are not minor footnotes in a financial report. These are warning signals from the front lines of a global system under enormous, unprecedented stress. And then we looked at who is buying. Not one country, not two, but 22 central banks simultaneously, collectively, deliberately accumulating gold at nearly double the historical rate. For the first time since 1996, gold now accounts for a larger share of central bank reserves than US Treasuries. A powerful signal of confidence in the metal's long-term value. The most conservative, most risk-averse financial institutions on the planet have made their verdict clear, and their verdict is written not in words, but in tons of physical gold sitting in their vaults. Morgan Stanley then, we talked about what this really means for the dollar. And this is the part I need you to carry with you long after today. Within a single year, gold overtook the euro as the world's second most widely held reserve asset and was recognized as a tier 1 asset in the international banking system, reflecting its increasingly central role in a transforming economy. The architecture of global finance, the architecture that has been in place since the end of World War II, is being quietly but decisively restructured. And the people engineering that restructuring are not bloggers or speculators. They are the finance ministers and central bank governors of the world's most powerful nations. SBC Gold, and then we looked at the numbers, the price forecasts, the institutional projections. Gold has been the best performing major asset class over the past 2 years, nearly doubling the returns of the S&P 500 over the trailing 12 months. And still, the overwhelming majority of everyday people are sitting on the sidelines, still waiting, still assuming that because something has already gone up significantly, it must be too late. But the institutions are not behaving like it is too late. 76% of central bank officials expect gold to make up a higher share of international reserves over the next 5 years. They are not scaling back, they are accelerating, because they understand something that takes most people too long to accept, that the beginning of a structural shift always looks expensive, right up until the moment it looks cheap in hindsight. Vanek SBC Gold here is the truth that ties all of this together. Gold's longer-term outlook remains supported by the same forces that drove it in 2025. Central banks and investors seeking protection, diversification, and de-dollarization in their reserves and portfolios. Rising geopolitical risks, trade tensions, inflation concerns, a potentially weaker dollar, and the risk of a meaningful correction in stretched equity markets should all continue to support gold. These are not temporary conditions. These are structural realities that are not going away next quarter or next year. The forces driving gold are the same forces reshaping the entire global order, and that process has decades left to run. VanEck, here is where I leave you. Not with a forecast, not with a price target, but with a mindset. The most dangerous position you can be in right now is the position of the person who understands what is happening, nods along, and then goes back to doing exactly what they have always done. Knowledge without action is just expensive entertainment. The central banks of the world have already made their decision. The governments have already made their move. The institutions have already placed their bet. The only one that matters as you walk out of here today is whether you are going to let history happen to you, or whether you are going to be someone who saw it coming and chose to act. The choice, as always, is entirely yours.